What are the key profit drivers in any business? Well, there are 6. Number 1, transaction value. So what is the average value of each transaction? Because if you can consistently make improvements to the value of each transaction, you will increase the profitability, you will increase the cash flow, you will increase the value of the business. Purchase frequency. So now we have an average value and we sell X times per year. If we can increase the frequency by just a little bit, those 2 compound. So if we take both of those up by 10%, the impact is 10% times 10%. Yeah, so we end up with a bigger number. It's not just a 10% improvement, it ends up being a bigger number. We'll go into more detail. The profit margin. So we've got the transaction value, the transaction frequency, the profit margin on each purchase. We've got the overheads. If we can actually generate this profit and we can reduce the cost of doing so, then that will increase the profit, the value, the cash flow again. The acquisition, so acquiring new clients, and this is the one where potentially is lead generation times conversion. We use acquisition because that's a statistic you can pull out of your accounting system and you can measure it very easily, but really should drill that down one step further. And finally, client retention. So as you grow your business, you're going to lose clients, you're going to acquire clients, and it's the net clients you've got. So by focusing on these 6 key business drivers, these should be part of your dashboard. They should be the metrics you're looking at every day, every week, every month. If you're not looking at this monthly, I suggest you're looking at the wrong thing. These are really, really important. So we're going to go through each one of those now and just talk a little bit about them, and then we're going to go into the ones that we think for many businesses is absolutely key, critical. And obviously there's a whole session on each one of these that we'll go through shortly. So transaction value. So question, so what is your average transaction value? Do you know what your average transaction value is? Because you can only manage what you can measure. So if you don't measure this, if you don't know what this is, if you don't regularly look at it, if you don't discuss it with your team, chances are you're not going to be even aware what's going on, let alone be aware of the number and be able to track the improvements. If you sat down with your team or a group of peers and you knew what the number was and say, well, just ask the question, what can we do to increase this number? As soon as you start to focus on knowing what the question is, you're 90% of the way to having the answer. So you'll come up with dozens of ways you can increase the value. And when we go through this, the module on increasing transaction value, we'll give you a whole checklist of things you could actually implement and do. Question for you, do you offer bundles? So if you just sell a base product and you don't add the add-ons, then I think you're missing a trick. I think it's a classic mystery. I don't know about you. Every time I buy a mobile phone, I buy a screen protector. And these days, 9 times out of 10, you've got to go out and buy a charger as well. And for some reason, when I go and buy it from EE never offered to actually bundle into the package anything other than the phone. I have to go and buy the case and I have to go and buy the charger elsewhere. I think they've just missed an opportunity to increase the size of the transaction. And do you use scripts? This is really easy. Do you want fries with that? That one line used by a well-known burger chain with some Archie golden things in their logo. Yeah, that is credited with increasing their total sales by 40%. How much does it cost them to go and ask the question, do you want fries with that? Nothing. Do they always use it? No, they don't actually, but they should. It's part of their script. It's the way they should be doing things. So strategies to increase transaction value. But the most important thing here is you need to know what your average transaction value is. And I would suggest also identify with each one of your clients, are there any products or services in your portfolio that you believe your clients need or want, in which case you could potentially suggest they purchase it, which is a really simple way of solving problems your clients have got and would potentially want to go and solve either with you or with somebody else. It's a great way of increasing the transaction value. But you do need to measure and track and monitor your average transaction value. Purchase frequency. The average number of purchases made during the year per client, ideally. How often do customers purchase today? And in an ideal world, how often could they purchase? So, I don't know, whether you're running a pub, could you get people to come into the pub more frequently? Could you get them potentially to come in at lunchtime and dinner? if you persuaded someone who only drank to come in and eat food, these are all strategies to increase the purchase frequency effectively and the transaction value. So again, ask this question. So once you know what your base point is ask the team, start thinking about it, obsessing about it. What could we do to increase the purchase frequency? Just try and make small changes to move the dial. Once again, you need to know where you're starting so that you know that if you are implementing things that are intended to improve the metric, you can measure the impact. So if you make changes and it doesn't have an impact, stop doing the things that aren't working. If you make changes and it has a detrimental impact, well, stop those immediately. But if you find things that are working, do more of them and keep moving the dial. Number 3, margin. Do you know the percentage profit margin you make on each sale? You might break this down by customer, you might break it down by product line, but you need to know what your margins are. Do you track your gross margins? So if you watch the trend over time, there's an absolute classic here that I think as business owners, we are guilty of not having been educated by our advisors in many cases. Just ask yourself a question. Has your accountant ever suggested to you that you ought to actually record your revenue and the associated costs in the same period, as opposed to, let's say we're building, I'm a website developer, I'll make a sale in January. And if I make the sale in January, I might actually raise the invoice and the customer pays, and I put the revenue straight through the books in January. But it could be that I've got a subcontractor that I'm working with, and I start working with them. I've received my money in January, and actually we start working on the job during February, and they don't actually invoice me until the end of February, but they're a bit late, so I don't get the invoice until March. So they invoice me in March. How on earth do I know what my gross margin is? Because of my revenue in January and associated costs coming through in March, now you make my business a bit more complicated. So I've got lots of transactions going on. Okay, again, does your advisor recommend to you, does your bookkeeping religiously, systematically recognize costs and associated revenue in the same period? And only if you do that can you actually track gross margin. So it can get a bit complicated. So you can sit down with your team once you know what the numbers are and say, what can we do to track and improve gross margins? And then if you've got your systems right, you can actually make sure that it's having the desired impact. If it's working, do more of it. If it's not working, change it. If it's not working at all, stop it. And I'll ask a question about, do you know the impact of discounting? The quick advice here is don't discount. When we do the module on discounting and improving margins, I think you'll be quite shocked. Key question, however, the key metrics you must have, this input that you need to monitor is the margin you make on each sale. Overheads, number 4. So are you using the best suppliers? Might be one of the questions. What's the best supplier? Well, there's various ways, but one is the price, the second is the quality, and frequently just because it's not the cheapest doesn't mean it's not the cheapest overall when you look at the total impact on the business, because some of these suppliers are at different costs. We'll go into more detail on this when we cover overheads. In your overheads, it's not just about cost cutting. In fact, cost cutting should be systematic and should be high on the agenda, but it's not about cost cutting. It's about looking at the things that you're spending money on and making sure that the stuff that is actually an investment is giving you a positive ROI. Your biggest expenditure line almost certainly is going to be labor. And the more efficient and more effective the labor you've got, your headcount, your people, the more you can get out of them before you have to take on a new person, the better. Another one is like marketing. Is your marketing generating a good return on investment, or actually is it costing you more to pay for the marketing than actually getting back in sales and profit? So you need to be making sure you're getting a positive ROI. You need to be looking to see if your operational efficiency, the return on investment on your staff can be improved. And note, savings can only be made once, but you can get more and more and more efficient. And as you grow, you should get more and more efficient. Key thing here, I'd probably say with your overheads is look at the overheads that should generate an ROI, identify them, and look for strategies to actually make sure that ROI is consistently improving. You'll get more and more efficient over time that way. Then we're into the easy one, the hard one. Okay, this is really hard. It's the one that everyone goes to first. So client acquisition. So do you track your leads and conversion statistics? So how much does each lead cost? what's your conversion rate by lead source, and what's the cost of acquisition per client. Because if you know the cost of acquisition and you know how much profit you make during the lifetime of the relationship with the customer, then you can work out what your ROI is on new customer acquisition. And again, you can continually work to improve it. And you'll see that some of the stuff we've already mentioned about improving the number of transactions, the transaction value, the profitability, they will improve the lifetime customer value and enable you to actually invest more in lead generation conversion, more in client acquisition. You need to know what your best lead sources are. But if you don't measure and track the cost of leads and the conversion and the value of the clients that accrue from it, then potentially you're paying for leads that are really just not worth it. Cost of sales versus lifetime customer value, that flows out of the above. And do all your leads generate the same ROI? Because if they don't, and obviously some leads are better than others, clearly you should max out your opportunity with your best leads rather than potentially treating all leads with equal priority. So you need to track the cost of leads times conversion to be able to control it, and then ask the question, what can we do to improve? Client retention. This is massive. This is massive. Most businesses tend to pay lip service to this, and I don't just mean small businesses. I mean all businesses. A lot of them, they have a customer service department, which in theory is responsible for looking after client retention. Have they in reality got a department dedicated to improving customer satisfaction? No, they've got a complaints handling process. That's not a way of improving client retention. That's a way of maintaining the status quo. So do you regularly report on your client attrition or customer attrition rates? Do you have an effective process for obtaining feedback from clients to work out which clients are happy, which clients aren't, and if they're not happy, what are the causes of dissatisfaction? Because again and again, what we find is that if you look at this in more detail, a very small handful of problems would be causing the impact for 90% of all the issues that are reported as problems by your clients. And if you fix just 3 issues, you can have a dramatic impact on customer satisfaction, but not if you don't know what the issues are. So you need an effective feedback process. In other words, you need to get from your client them to tell you what they think you could do better. Have you got an engagement strategy? So if your clients tell you that they'd like you to do X, Y, Z better, the best way to actually improve the engagement in that instance is to do what it is they said they would do, or engage with them and tell them why it's impossible. Talk to them, engage with them. Regular communications rather than, if they don't come into the store or they don't purchase from you, you never communicate with them. That's not a great strategy for improving engagement. It's not a great strategy for improving satisfaction, loyalty, or improving retention. So do you have a referral process? So if you've got really, really happy clients will be happy to refer. Ideally have a referral process. So actually that's almost overlapping now with customer acquisition, linking it very directly to customer satisfaction, customer retention. Key data here is you need to track your customer attrition rate.